This is a presentation about corporations and how to record the retirement of shares. Retirements of shares are like the reversal of investment entries. Instead of receiving assets, the corporation gives assets back to the shareholders and cancels the share certificates. We'll start by looking at a company and its initial investment transactions. We're debiting cash and crediting common shares for $80,000 in the first transaction and issuing 10,000 shares to shareholders. In our second transaction, we're debiting cash and crediting common shares for $190,000 and issuing 20,000 shares to shareholders. So at this point, we've issued a total of 30,000 common shares, and our balance in the common share account is $80,000 plus $190,000, or $270,000. We'll assume our first year of operations was profitable, earning a net income of $45,000, and here we have the entry to close that to our retained earnings account. So that's our opening share position. Looking at our general ledger account for common shares, we see the two entries, the first one a credit of $80,000, the second a credit of $190,000, our total common share balance $270,000. On the balance sheet shown in yellow, we show our common shares, unlimited authorized 30,000 shares issued and outstanding, dollar balance $270,000. We also show retained earnings, which includes only the net income of $45,000. To record the retirement of shares, we need to know the average issue price on the date of retirement. On the date the first share issue took place, our average issue price was $8 per share. The $80,000 balance divided by the 10,000 shares, or $8 per share. After the second share issue, to calculate the average issue price, we need to take the total balance in common shares, $270,000, and divide that by the total number of shares issued, 30,000 shares. So $270,000 divided by 30,000 shares means that as of that date, our average issue price is $9 per share, and we'll use that information to record retirement. We'll take a look at an example of a retirement entry next. Here we're retiring 1,000 shares. 1,000 shares are purchased, that is bought back from the shareholders, paying out $7 per share, and then the shares are retired. Our credit to cash is $7,000, 1,000 shares times $7 per share. After we buy back these 1,000 shares, we'll then have only 29,000 shares outstanding, the original 30,000 minus the 1,000 we're buying back. The debit to common shares is the average issue price times the number of shares. So that's $9 times 1,000 means a debit of $9,000. The difference is like a gain. However, we cannot have a gain or loss on our own equity accounts, so it must instead go to an equity account. That equity account is called contributed surplus or contributed surplus from retirement of shares, and that would be credited for the difference of $2,000. That contributed surplus would be reported under contributed capital on our balance sheet. Here we see in the yellow square the second account down, contributed surplus $2,000. You'll notice our common shares have been updated, now only 29,000 shares issued and outstanding, with a balance now of only 261,000. Our retained earnings balance is unchanged. We'll now carry on and look at a second transaction where we pay out more than the average issue price to buy it back. It ends up reducing equity accounts. Okay, in our second transaction, we buy back 3,000 shares, paying $10 per share, or a total of $30,000. The debit to the common share account is again the average issue price of $9 times the 3,000 shares, or $27,000. Here the rules are different. First, the debit must be applied against any contributed surplus accounts, and then if the debit exceeds that amount, it would go against retained earnings. So in our example, we would first debit contributed surplus for $2,000, and we still need a further debit of $1,000 to complete the entry. If there is no contributed surplus, the entire amount would be debited to retained earnings directly. So here's our entry. We issued the shares for $9. We paid $10 to buy them back. That had the effect of decreasing our equity by $3,000, which we apply first against contributed surplus and then against retained earnings. Looking now at our updated accounts, we can see our common shares have been updated, now only 26,000 shares outstanding, the balance of $234,000. Our contributed surplus is reduced to zero, and our retained earnings is reduced by that $1,000 debit from $45,000 down to $44,000. So here's our updated equity. Notice that we removed these shares at $9, so the average issue price in the common share account is still $9. This concludes our review of retirement of shares.